Success in business isn't built on avoiding mistakes. It's built on how well you manage them. Warren Buffett knows this better than anyone. For decades, he's navigated the complexities of corporate ownership, watched good ideas fail, and seen unexpected winners outperform all expectations. But through it all, one principle has guided him. Allow the natural momentum of great businesses to do the heavy lifting, and let the poor ones quietly shrink out of your portfolio. When Buffett talks about investments that didn't work out, he doesn't flinch. He's open about the fact that some deals are wonderful and some are terrible. But instead of dwelling on the losses, he observes a simple truth. Bad businesses tend to become a smaller and smaller part of your portfolio over time. If you're paying attention, that's because they stop growing. They stall, they stagnate, and eventually they fade. By contrast, successful businesses, like Geico, grow disproportionately. Geico, for instance, now does 15 times more business than when Berkshire Hathaway first took control, without needing to add more capital. The investment naturally became a more valuable part of the portfolio simply because it flourished. This is a quiet power of letting winners run and not clinging to losers out of pride. Charlie Munger, Buffett's longtime partner, compares this to raising children. The difficult ones might cause the most noise, but it's often the quiet achievers who bring the most value over time. Buffett jokes that they started Berkshire with 3 businesses: a textile company, a department store, and a trading stamp business. All 3 failed, but that didn't sink the ship. Instead, it taught them that failure at the beginning doesn't prevent success in the long run. The real risk: people in power who shouldn't be. When Buffett looks back at what destroys companies, it's rarely the market. It's not inflation or recession. It's mismanagement. He's seen time and again that a charismatic, likable leader can win over a board of directors, even when they have no idea how to run the business. And once someone like that is in place, the damage they do often goes unchecked for years. This is the number one risk factor Buffett sees in companies: poor leadership disguised by good presentation. You won't see this on most official risk disclosures, because legal teams usually focus on external threats: supply chain issues, economic downturns, regulatory changes. But the real danger often sits in the executive chair. Buffett has watched businesses flounder not because of what they face on the outside, but because of who is allowed to remain in control inside. And when these individuals are personable, politically savvy, and seemingly competent, they stay in power far longer than they should. That's when once promising businesses get locked into failure. About crypto and dodging the obvious. Now, what about cryptocurrency? Buffett has always approached it with skepticism. When asked whether he still views Bitcoin as worthless artificial gold, he smiles and sidesteps. Not because he lacks an opinion. He has plenty. But because he knows the room. With hundreds of thousands of people tuning in, many of whom are Bitcoin holders, he jokes that it's not worth alienating 400 fans to please 2 short sellers. It's a rare public dodge from a man known for blunt honesty, but it reflects his wisdom in choosing battles. Charlie Munger, however, holds nothing back. He calls the rise of cryptocurrency, quote, disgusting and contrary to the interests of civilization. To Munger, the idea of minting billions of dollars through a product created from nothing, without underlying value, productivity, or societal benefit, is offensive to the very foundation of sound economics. Buffett's silence and Munger's fury show 2 paths to the same view. One avoids unnecessary conflict. The other tells the truth at full volume. The real threats we ignore. While people debate Bitcoin on stage, Buffett and his team are focused on risks that actually impact lives and companies. Pandemics, natural disasters, and systemic shocks that investors rarely price in until it's too late. Ajit Jain, who oversees Berkshire's insurance operations, highlighted how the industry underestimated pandemic risk for years. COVID-19 showed that while insurers were aware on paper, they assumed it was a once-in-100-years event. And even then, many didn't price it into policies with the depth and seriousness it deserved. Take event cancellation insurance, for example. Companies like NBC insure billion-dollar media rights for the Olympics. They consider earthquakes, terrorism, even geopolitical boycotts, but rarely include pandemic-level interruptions in their premium models. COVID changed that. Berkshire and others are now rethinking how correlated risks ripple through entire portfolios. not just in obvious ways, but through hidden channels, like how one event affects dozens of business lines. Insurance, legal clarity, and the fallout. Buffett notes that policy language matters immensely, especially when disaster strikes. In the UK, for instance, legal rulings around business interruption insurance lean more heavily in favor of policyholders. In the U.S., where contracts were written with stricter language, courts largely sided with insurers. It's a reminder that you don't get coverage for things you didn't pay for. And sometimes, you don't realize what you've paid for until it's too late. That's the complexity of the insurance business, and by extension, the investment world. Risk is rarely what it seems. And the biggest threat is often the one you didn't even know you were exposed to. As we continue to part 2, we'll dive into how Buffett recalibrates his strategies in the face of these systemic risks, how the culture at Berkshire is built for long-term resilience, and what ordinary investors can learn about filtering hype from substance in a world full of noise. But before we go, take a moment and reflect. What's the biggest hidden risk you've learned to spot over time? Share your insight in the comments. It may help someone else avoid a costly mistake. And if this gave you a new perspective, don't forget to like and share with others who follow investing and business closely. When the world stopped in 2020, insurance companies, governments, and businesses faced a brutal truth. We weren't ready. Not financially, not logistically, and certainly not in terms of risk modeling. And while the shock was global, those who studied risk professionally, like Warren Buffett's team at Berkshire Hathaway, realized something even more troubling. Pandemic risk had been accounted for, but underestimated. Ajit Jain, the head of Berkshire's insurance division, put it plainly, we knew it was a risk. We just didn't think it would happen in our lifetime. For decades, actuaries assigned pandemic scenarios a frequency of once in a century, sometimes even less. The logic was simple. These events were a rare, massive, and impossible time, so they were mostly ignored in pricing models or treated as fringe possibilities. And when they did make it into policy terms, the exposure was often wildly underpriced. The Olympic problem. Jane gave a striking example. Broadcasters like NBC spend billions securing the rights to events like the Olympic Games. To hedge their bets, they purchase event cancellation insurance, which protects their investment if, say, an earthquake disrupts the event or political tensions keep athletes from competing. But here's what most insurers didn't do. They didn't price in the risk of a global pandemic shutting down everything. And when the Tokyo 2020 Olympics were postponed, insurers learned the hard way that the policies they sold may have covered far more than they expected. This isn't just an insurance story. It's a lesson in assumptions. As Buffett has long taught, the danger isn't just in taking risks. The danger is in taking risks you don't understand or refuse to quantify properly. The real meaning of risk. In finance, risk is often boiled down to volatility. But Buffett's definition is different. Risk comes from not knowing what you're doing. It's not about how much something moves. It's about how confident you are in your understanding of it. And sometimes, the very structures meant to handle uncertainty, like insurance contracts, reveal how little we actually comprehend systemic risk. During the early waves of COVID-19, many businesses discovered that their business interruption insurance didn't cover losses from a virus outbreak. They thought they were covered. They weren't. Meanwhile, some insurers discovered they've written policies that unintentionally did cover pandemic-related losses. It wasn't malicious. It was poor wording, poor forecasting, and poor calibration of what was really at stake. Legal language, global gaps. Buffett emphasized that legal frameworks vary dramatically by country. In the United Kingdom, some cases were ruled in favor of policyholders, especially when ambiguity in the contract existed. In the United States, where insurers wrote more conservative and exclusion-heavy policies, courts largely sided with the insurers. This divergence is key. It shows how the same event can have completely different financial outcomes based on contract language and local legal norms. Buffett's takeaway? Future policies will be written with far more precision. Ambiguity is expensive, and when billions are on the line, every word matters. This is the kind of strategic, detail-focused thinking that Buffett has applied to every investment Berkshire has made, whether it's an insurance contract or a $10 billion acquisition. It's not about predicting the future. It's about making sure you're not exposed to unacceptable outcomes, no matter how unlikely they seem. The lessons are bigger than insurance. The pandemic exposed more than just financial vulnerability. It revealed how interdependent everything has become, from supply chains to stock markets to healthcare systems. And in that interconnection lies correlated risk, something the insurance industry now must grapple with on a much deeper level. For decades, insurers treated risks as mostly isolated events. An earthquake in Japan, a flood in Europe, a factory fire in Texas. But pandemics are global, simultaneous, and cross-sector. When one domino falls, others fall faster than anyone expected. This is where Buffett's philosophy shines. Don't underestimate what you don't fully understand. And when in doubt, hold margin of safety. This is why Berkshire doesn't just rely on insurance to protect capital. It also holds massive cash reserves, owns businesses with strong balance sheets, and invests in companies that can withstand extreme environments. It's not about fear. It's about resilience. Why most investors miss these signals? The average investor thinks in weeks. Buffett thinks in decades. He isn't concerned with next quarter's earnings or this week's stock price. He's concerned with whether a business, a contract, or a decision can stand the test of time, including through once-in-a-generation events like COVID-19. That's why he values leadership over flashiness, simplicity over complexity, and cash over speculative gains during uncertain times. Buffett knows that real wealth isn't built by winning every trade. It's built by avoiding ruin and capturing long-term opportunity when others are unprepared, building an investment framework around risk. So how can everyday investors internalize these ideas? Start by understanding that risk isn't a formula. It's a feeling. It's the nagging voice that says, "This seems too good to be true." It's a humility to say, "I might not understand this as well as I think I do." And it's a discipline to build a portfolio that won't fall apart during hard times. Here are a few timeless practices inspired by Buffett and Jain. Be cautious with assumptions. Don't assume you're protected just because everyone else seems confident. Most people ignore risk until it's too late. Read the fine print. Whether it's a stock prospectus or an insurance policy, details matter. Learn how the structure works, not just a story. Think in scenarios, not probabilities. Just because something is unlikely doesn't mean it's not devastating. Always ask, what if I'm wrong? Maintain liquidity. Have access to cash or safe reserves. Buffett's mountain of capital didn't happen overnight. It was built with intention for moments when the world was panicking. Avoid businesses that rely on perfect conditions. If a company or product only works in a booming economy or smooth supply chain, it's not resilient. Favor those that are built to survive the worst. Prepare before the storm, not during it. Buffett's strength comes from always being one step ahead in risk awareness, not reaction. As we transition into part 3, we'll explore how Buffett uses these insights to position for opportunity, how individual investors can benefit from dry powder strategies, and why discipline beats intelligence in the long run. But before we move on, here's something to reflect on. What's one area of your financial life where you've overlooked risk? Share your experience in the comments. It could give someone else the insight they didn't know they needed. And if you found this part helpful, share it with someone who might still be focusing only on rewards without seeing the risk behind them. There's a reason Warren Buffett is often called the greatest investor of all time, and it's not because he always bought at the bottom or predicted the next big tech stock. It's because he has mastered something far more powerful: emotional discipline in the face of noise. While the world reacts to headlines and hot trends, Buffett stays grounded in principles that rarely change. And one of those principles is this: you don't need to act all the time. You just need to act wisely at the right time. That's why when others panic, he positions. When others chase, he waits. And when others assume the future will look like the past, he quietly studies the exceptions. Cash isn't lazy. It's a strategic weapon. One of the most misunderstood parts of Buffett's strategy is his willingness to sit on huge amounts of cash for long periods of time. For many investors, cash feels like missed opportunity. But for Buffett, it's preparation. Cash gives you optionality, the ability to move when prices are low and others are forced to sell, psychological clarity, the freedom to observe without pressure, Resilience, the strength to avoid bad decisions when the market goes wild. Buffett doesn't care if treasury bills are earning just 4 to 5%. What he values more is control. Control over timing. Control over decision-making. Control over when to strike. As he famously said, opportunities come infrequently. When it rains gold, reach for a bucket, not a thimble. But you can't grab a bucket if you already poured everything into the last shiny object. The real advantage, a long-term lens. Buffett and Charlie Munger often emphasize that intelligence is not the key to investment success. Temperament is. And that's something most investors overlook. The real advantage Buffett has is the ability to think in decades, not days, to ignore the media cycle, to resist FOMO, and to trust that value always reasserts itself when the crowd gets carried away. This kind of thinking requires patience to wait for great businesses to become undervalued, discipline to do nothing when nothing makes sense to buy, conviction to invest heavily when fear dominates the market, and the data backs this up. Many of Buffett's best investments came during crisis periods. In 2008, when others were selling, he invested billions in banks and industrial giants. In 2011, when uncertainty clouded the economy, he made bold long-term bets. Even earlier, he capitalized after the dot-com bust because he had stayed out while others dove in. Buffett's performance isn't just about what he bought. It's also about what he avoided. You don't need billions to think like Buffett. Most people assume Buffett's strategy can't be applied without his capital or his access. But that's not true. His principles are scalable. They apply whether you have $1,000 or $10 million. Here's how you can follow the same path. 1. Stay within your circle of competence. Only invest in businesses you truly understand. If it takes a 30-page prospectus to explain it, it probably isn't a good fit. 2. Avoid excessive complexity. Buffett's portfolio is built around simple, profitable businesses with long-term prospects. Don't get seduced by exotic investments you can't explain in plain English. 3. Ignore the noise. Market headlines are designed to trigger emotion. Turn them down. Tune into fundamentals. 4. Keep dry powder. Always maintain some cash. Not to time the market, but to capitalize when others are forced to sell. That's when the best deals appear. 5. Invest in yourself. Buffett has always said the best investment is in your own earning power. Education, skill building, and career growth create wealth that no stock can match. 6. Adopt a mindset of a collector, not a trader. You're not flipping baseball cards. You're acquiring pieces of real businesses. Treat them that way. Final reflection, the Buffett equation. At the heart of Buffett's success is a simple equation. Discipline plus time plus simplicity equals extraordinary results. It's not about secret formulas or perfect timing. It's about consistent habits, clear thinking, and emotional maturity. Buffett doesn't try to predict the next recession. He doesn't obsess over interest rates. He watches, waits, and prepares. And when the world gives him a once-in-a-decade moment, he's ready mentally, emotionally, and financially. That's the lesson. And it's available to anyone willing to take the long road. You won't get rich overnight, but you will build something real. And in a world of hype and shortcuts, that makes all the difference. As you finish this journey, ask yourself, which Buffett principles spoke to you most? Leave your thoughts in the comments. We'd love to know which part of this philosophy you're ready to apply starting today. And if this helped clarify something you've been struggling with, consider sharing it with a friend who could use a little investing wisdom too.